people just thought like, hey, if we rehab it, they will come, and they didn't think about sort of real estate 101. Like, really, if you're going to raise the rents on this property to $1,800 a month, are the people who can afford to pay $1,800 a month going to move to this neighborhood?
Folks, it appears we are on the cusp of 2006 level wealth destruction. Now, this wealth destruction will not be occurring in some of the markets that you all are thinking about, but we have a story from Ken McElroy that highlights real pain, but also some real opportunity. We're going to go through some details on a building that had a 65% reduction, and we'll go through the details. Let's talk to Jonathan Twomley. How you doing, buddy?
I'm doing great. How are you?
I'm doing well. So
this is 5%. I mean, God, wow. So a lot of things went wrong on that property,
yeah,
for sure.
Yeah. So we're going to talk about the property, but I want to ask bigger questions. Like, is this a one-off? Is this a sign of pain to come? How do people take advantage of this? And, maybe even, when do the dominoes start falling? So here's the deal. This was on Ken McElroy's podcast, or I interviewed him earlier in the week. It's already published, but here's the deal. He got a phone call from a bank about an apartment building in Texas. He didn't want to go into which city, but again, in Texas, roughly 400 units. Last purchase, Jonathan, for $40 million. 40. The syndicator brought in $15 million of LP money, right, for the down payment, and they got a bank loan for 25. Fast forward a couple of years, the bank is now taking it back, and they called up Ken and offered him the building at $14 million. Wow. The building is 40% occupied, or I'm sorry, 40% vacant, so 60% occupied. Ken said that the value add was bad, not done well, not done quality. So again, a lot of the work that was done probably has to be redone. And I think the most important thing about this conversation, Jonathan, is Ken passed.
Mm-hmm.
He's like, not deep enough. And again, folks, 40 to 14, that's 65% off. So what are your first thoughts when you hear about deals? And, oh, by the way, you hear that Ken passed even at those deep discounts.
Okay, so you said this was 400 units? Was that what it was?
I think it was 400 units. Might have been 280. Anyways, hundreds of units. I remember the financial numbers. 40 purchase, 25 debt. Bank's trying to sell it for 14.
Okay. Well, my first thought on hearing that was a deal that size, that many units bought at the top of the market, presumably for that price, suggests to me that this was probably a C deal. So this is probably an older property, because the Class A deals were trading, and even like some B and C stuff was trading for $150,000 to $250,000, 200 or more a unit, right? And so if this deal was quote unquote only trading for about 100,000 a unit,
right,
that suggests that this was not a in a great neighborhood. So
no, I think you're absolutely right. And I love how you just peel that apart with just a couple of factors. And Ken talked about it as well. He's like, Michael, this it just became a value add, deal junkies with Excel spreadsheets, and they were frankly overpaying, and they were paying prices, for C quality stuff or even D stuff at stupid levels. It's destined to fail.
There was this idea that you could not fail. Right. All you had to do was rehab a property, and then the riches would be rolling in, and people just lost whatever discipline they had. I think a lot of people started out without any discipline. And I just have an aside in a second I just want to mention to you as an example of this. But so people just thought like, hey, if we rehab it, they will come, and they didn't think about sort of real estate 101. Like, really, if you're going to, raise the rents on this property to $1,800 a month, are the people who can afford to pay $1,800 a month going to move to this neighborhood? Right. And I think a lot of people got really high on their own supply by thinking that, well, there's a housing crisis and people will come. if the rent is cheap, people will come. And they forgot about like location. It still matters in real estate, right? So
Yeah.
that's right off the bat. I see like kind of red flag right there. That as to why Ken would pass.
Yeah, and again, this was what I saw because again, I tell everybody about a meeting I went to in San Jose where I was the boring one rental at a time guy, and there was this brand new syndicator, never done a deal, never owned anything, but I'm sure he raised millions of dollars to buy out-of-state apartments. Never even saw them, but boy, was his spreadsheet sexy. And I'm like, guys, you're just throwing your money away. What are you doing?
Yeah, I mean, I saw, won't name names, but I saw a post the other day by a really prominent syndicator sort of recounting their history of glory. And this person in particular started multifamily investing at 2018. So basically already near the top of the market, right? With zero experience, right? Other than a sales job and just super young. So no life experience, right? And then bought a ton of property, basically all at the top of the market, right? So basically it's like someone saying, hey, they were bragging about their history, but it's sort of like, hey, you're just telling the world that you started at the top of the market with no experience in real estate, no life experience, and you bought a ton of property, which the only way you could do that is if you were overpaying left and right.
Oh, yeah.
So like there is no way you could buy that much and be conservative and actually know what that means. And just waiting for the other shoe to drop here, basically, that just, you haven't, I don't know what you're bragging about.
The story's not over. You're halfway through, my son.
Yeah, exactly. So, but back to Ken's story. So if he's now saying, so let's just say it's 280,000, he's saying, hey, I won't buy this thing for 50,000 a door. Right. If it's 280 units and they're asking 14, so it's 50,000 a door. And he's saying no.
Right.
That's because he's looking at the property and saying, well, I'm going to have to redo all these units. It's probably going to be, since they did a bad job, it's going to be another 20,000 a door. And I'm not sure this thing is worth 70, 75 a door, given where it is. So, yeah.
So I totally agree with that. But I want to step back and go deeper because again, I think what's interesting in multifamily and again the multi-million-dollar properties is, and Ken talked about, right? Class A is already retrading and arguably already getting a lot of activity, right? People are kind of called the bottom. Jonathan Gray called the bottom. Grant Cardone and Ken are being very active, right? Ken's taken down something like 300 or 400 million in deals in the last 6 months. So he's being active at that level. But what I see in Class B and Class C is still a market that's busted. So when I hear about this deal, 40 to 14 and a pass, it sounds like the really terrible junk is starting to bleed off, which means the other stuff is coming. And Ken said probably 2026 for Class B and Class C to get unlocked in any meaningful way. Does that feel right?
Yeah. I mean, I'm still not sure the bottom is in, but I don't think it really matters necessarily. Like, you know what I mean? Like it doesn't matter whether you time the absolute bottom or not. Like, I think what a lot of those bigger and well-funded players are thinking is like, okay, knowing that if I wait another year, I might get another 10% discount. Am I happy buying at a 25% discount right now, knowing that where I'm buying in the cycle, the likelihood is that it's going to be worth more when I need to refinance or sell, right, than it is right now because of the discount I got. So it kind of gets my hackles up a little bit when people are like, look at John, the bottom is in, because John Gray is buying. It's like, no, John Gray is making a calculated decision that it doesn't matter whether the bottom is in or not.
He doesn't need that last 5% or 7%.
It doesn't matter. If you have the opportunity to buy this at a substantial discount, you do it.
Yeah,
right.
Exactly.
If they're good assets. That being said, I think that what Ken says about B and C, I mean, absolutely. I think all of that stuff, all of the worst of the value add bought on bridge debt at crazy valuations with sponsors who didn't know what they were doing, and everybody, everybody who was involved in this either thought like, hey, it's just, it's just so much like 2007, right? Where
It
people were
is.
taking liar loans and like, it doesn't matter because it's going to go up and I'll sell if, when the 2-year IO period ends and my payments go up, it doesn't matter because I'll sell and I'll be fine. I think the buyers were all like that. The lenders were selling the loans to someone else. They didn't care. And it's like, it's the same thing all over again, just different asset class. But so that stuff, so what's going to happen, I think, is that so the real bottom is going to happen when that stuff starts coming to market and there's no one to buy it.
Yep.
Right. That's when the bottom is in. And my friend Brian Burke actually, he just expressed it so well. He said, if you're not following Brian Burke, you don't know who he is. You really have to. He's just such a smart guy. But Brian said, we were talking a couple of years ago, and he said, I'm not waiting for buyers to be scared. I'm waiting for sellers to be scared.
Ah, that's nice. Yes.
That's when the bottom of the market is, not when buyers are scared, but when sellers are afraid that if they don't sell now, it's going to go even further down and they have to get out. That's when the buying opportunity has arrived. And I think that we're going to be in that situation as increasingly as banks, so the way it's going to work is these deals can't be refinanced because they are worth less than the debt, right? So they can't be refinanced without a big cash infusion, which investors are not going to want to do, right?
Yep.
Then, so the lenders are going to be forced to take these things back, right? They're not going to extend the loans because they're going to look at these things and they're like, these properties are not going to recover. Right?
No, and they're falling apart. That's what people don't realize about this is banks, when they extend, the owner just bleeds it dry.
Yeah. But not only that, but there's another thing that I think a lot of people don't understand about commercial property, which is that, so you have what's called a DSCR requirement, debt service coverage ratio. And if you are paying your debt, so you're current on your mortgage, but you fall below the required ratio, what the lender does is they then take control of your cash flows, and they only give you like the bare minimum of money to run the property. So that may mean that it's even not just like the lender may actually stymie the owner's ability to maintain the property. It's completely counterproductive. I don't really understand why lenders do this, but like they're like, well, our interest has to get paid, and so that can be a reason for the property to start deteriorating as well, because then vendors aren't getting paid, they stop showing up to do work, and it's a vicious cycle. Then the property just declines further in value. So it can be not just the owner saying like, I'm not putting the money in. It can also be the owner saying, I'm not putting the money in because the lender's got all my money. I would put the money in if I could, but I don't have it. I don't have the cash because they're holding on to it. Right. So, So I think that what's going to happen then is, so the progression will be lenders being forced to take these deals back because they really have, there's nothing else to do. They can't.
There's no there. Yeah.
There's no there. And then they'll try to go to market with them and they'll try to sell them at a dollar number that recovers their debt. And they're going to find that like people don't want them, because even on paper, if you say, well, yeah, stuff is trading for 50,000 a unit, right? When people go and look at the asset and they're like, well, yeah, but it's going to take $20,000 of work, or it's like, this is the middle of the hood or whatever. And then when no buyers show up, then you just are going to start seeing the panic sales or these deals packaged up and sold for, $7,000 a unit in big portfolios and stuff like that. So
it's going to get really interesting. I love that little, was it Brian Burke? I love that little twist. I'm not worried about when buyers are scared. I'm worried about when
I'm looking forward.
Looking forward.
So that's when I know the bottom is in, when the sellers are scared.
Yeah. The other thing I'm hearing with, again, I, as you know, I'm an accredited investor, and I'm starting to see more and more, I'm going to call them marketing deals coming to my inbox. And basically the lead line is, look, we're getting this for 10% off the last purchase. I'm like, how the hell does that make it a good deal? What are you
Really?
guys talking about?
I
It's
would love to
crazy.
see forward one of these to me because I would love to see this. But yeah, if anybody's
Yeah.
bragging about 10% off peak pricing, I mean, that is
What are you
just,
doing? Yeah,
yeah,
it's
that is not,
rookies. Not
yeah,
good.
yeah.
Not good.
The market has gone down by more than that. So
Yeah. So let's kind of give people some to-dos and some gotchas. I think the first one you brought up earlier is, you can't fix the location,
yeah,
right? An overpriced building that got cap rate compression in the hood is, it's the mean reversion on that is going to be nasty, i.e. 40 to 14, and apparently worse because he passed at 14. So it's got to
yeah,
be better than that.
yeah.
So that's something. What else? Because again, I think we're going to see more and more people looking at the dustbin of deals. What are some gotchas and some red flags you'd be looking at?
Well, I don't know. I mean, there's, I don't know if you're aware of this, but there was a whole, we talked a lot about funky debt structures that people use to get deals done. There was another thing going on in Texas and in some of the southern states that people were doing to get deals done, which was signing up. So basically, there was a loophole in the law in Texas that if you agreed to keep your rents below the median rent and you signed a deal with a nonprofit, you get like your property taxes either waived or like significantly reduced.
Wow.
Right.
Okay.
And then so people were then discovering like, hey, I just found this deal where the market rates are actually below the legal median rents. Right. So I don't have to actually, I can like keep on raising rents and still get this tax break. And I don't know what the nonprofit angles on these things were, but I have a feeling that there were a lot of like shady quote unquote nonprofits that got set up. And so now the state of Texas has basically has come back and said like, because, in Texas, they need those property taxes because they don't have a state income tax. Right. So so abuse of this kind of thing, like it matters to these municipalities. Right. So they've basically cut that off, which means that a lot of these deals that were getting a tax break, like, well, that tax break just went away. Yeah. So that's going to put some of these people into like a default situation because they overpaid based on that like, hey, we're paying less tax. So that's something too. When you see some of these deals that their valuation was based on this tax break that's now going away, and the next buyer is not going to get it, then again, that's why like you would pass on the deal or say, no, it's got to be a steeper discount. Right?
Yeah.
So
the other thing I see going on in this space, because folks, it's still going to get messy. There's still going to be lots of losses and pains and pain and people going to jail probably. But according to the Real Deal, more and more financial institutions are invoking the bad boy clause and going after personal guarantees. A lot of these creators are now going to be put in positions where maybe they have to sell the good assets to pay for the sins of the bad assets.
Yeah, I mean, listen, so this is another thing too. I mean, everybody kind of thought that these, and I remember digging into this years ago when I first got started, like, well, how likely, are they going to come after you? And and I was hearing from mortgage brokers who are saying like, I've never actually heard of anybody of them ever going after anybody on one of these bad boy carve outs. Right. And, and maybe that's true when like the market is reasonably strong and there's no deficiency if there's a forced sale, and foreclosures are few and far between.
Yep.
But, having been a lawyer, having been a litigator, right, I know that when you're as a lawyer or as a client, when you're looking for money, right, you're going to start taking a really close look at those bad boy carve outs and trying to figure out, well, is there a basis here where we can say that this was triggered and there's personal recourse, right? And I think for a lot of these syndicators who played fast and loose, right, or who frankly just didn't really know what they were doing or what they were getting into, and so therefore they kind of cut corners without even realizing it, or frankly believe like, oh, this will never happen, or people told them, oh, this will never happen.
Yeah,
right? It's like it's coming for some of those guys for sure.
Yeah, no, it's very clear. And again, after that Real Deal article, I looked into it. Apparently, some of these bad boy clauses are actually kind of wide open for interpretation. So I think you're absolutely right. If you have a deal that went south as a bank and that GP in this case has other assets, it's going to be open season.
I mean, some of them can be, like if the sponsor declares bankruptcy, then it's all personal recourse or,
Yep.
Fraud. Well, what does that mean? That could be pretty broadly interpreted, right? And if
Yep.
they, so I think that there's going to be, because the banks need to recover this money, and
Yeah.
and
At least some of it. Yeah.
yeah, because they're in trouble, right? And
Yeah.
they leaned into this too much, and you can always say, well, the banks shouldn't have been lending the money, but at the end of the day, it doesn't matter because they're the ones with the power. They're going to come after the borrowers. I mean, those deal documents, those loan documents. I mean,
Ooh.
I don't know if people know this, but when you sign one of these loan documents with a commercial lender, they make you pay for your own quote unquote lawyer. So someone representing you to draft a legal opinion that says my client has no defense against the enforcement of this loan document.
Wow.
And so that becomes an exhibit to the loan document. So if you were to go to court and try to fight it, they're going to pull out, well, look, his own lawyer said it's my considered legal opinion that he has no defense against enforcement of this loan guarantee or this loan. So, you don't have a lot of leverage.
Yeah, it's going to be really interesting. At the end of the day, what my takeaway from Ken's conversation is the biggest of the big boys are already being selective, but active. But the pain that's really coming to where I like to play is potentially way out to 2026. But it's going to be massive.
Yeah, and it's coming, and listen, I mean, there is going to be opportunity for everybody. And if you think that this is only limited to the big properties. No, that's not true. There's a lot.
I'll give you an example. It just came to my attention. A broker in Fresno, the market I know, called me and he goes, "Hey, Michael, didn't you own XYZ property? It's one of the buildings I sold in 2018, right? Because I thought we were at a cycle peak. I sold it for, let's call it $1,050,000. Call it $1 million. That particular property was sold 2 times after I owned it to 2 different people, ultimately ending up in a syndication. And they did a whole bunch of stuff. They probably put in about $250,000. But now they listed the property $2.85 million.
Wow.
What that means, if you guys don't know my market, is they are pricing it at peak Class A. And oh, by the way, the reason I sold this building is because the neighborhood was going downhill. And guess what? It is still going downhill. This building looks sexy and pretty if you only look at the pictures, but if you drive down this cul-de-sac, it is not good. And so this particular syndication, they picked up lots of buildings in the Central Valley. They overpaid for all of them, and guess what? They're trying to sell all of them now. What does that mean? They're in trouble. They now realize the rents are down, NOI's down, they can't refi, they're stuck. And the reason I bring this up is this is the exact story of a building I bought in the last cycle. In the last cycle, it was listed for $1.44 million. Why? Because that's what the seller bought it for, or the buyer bought it for before. That building deteriorated for 2.5 years. We ultimately bought it for $700,000. This building at 2.8 is not going to sell. It's going to maybe get an extended pretend. They're going to say this, that, the other. They listed it with one of the biggest brokers in the market, so they have that going for them. But this building is going to deteriorate. The neighborhood is not getting better. It's getting worse. And I'm saying it right now. This building will be sold for less than 1.2 when it ultimately transacts in a couple of years. It's wild.
Yeah, I mean, listen, I saw the same thing in South Carolina, where when I was starting out and first looking at deals, and it was really a similar kind of place where we are now. When I started looking at deals in Greenville and Spartanburg, I kept on seeing the same group in the chain of title over and over and over again, and followed by a sale for like a really small amount of money. So basically they got foreclosed on, right, on all their stuff. And one of the properties that I wound up buying, which turned out to be a great deal for us, I didn't even buy directly from them out of foreclosure. I bought it from the person who bought it from them and rehabbed it, right?
Oh, wow.
And then we bought it from them as a kind of buy and hold. But the first guy in that chain of title, well, not the first guy, but that particular guy, he had bought the property, then over renovated it. So one of the things I liked about this deal was like half of the building was renovated to this really high standard because they had just they just didn't know what they were doing, and they put too much money in, and they went bankrupt, and they went into foreclosure. And then the next guys came in and bought it, and they finished the rehab. They didn't do as high quality finishes in the other part of the building, but still they were a good rehabber, and they did a decent job. And so and it was a great property because people loved it because it had these high-end finishes for like a regular rental property, right? So but that's just typical top of the market behavior, right? People think I'm going to spend X per unit, I'm going to get these rents, and they don't really, and it's all based on like the frenzy that they're in, or like the frenzy for housing, or whatever it is, that they think the rents, that people have the ability to just keep on paying higher and higher and higher rents forever, right?
It's pretty wild.
Yeah.
Pretty wild. At the end of the day, folks, I think it is pretty obvious that a 2006 level of wealth destruction is coming in Class B and Class C assets. If Ken McElroy is getting calls for 65% discounts and passing, there's pain coming. It's still out there a ways because you only get the ugly ones today, but there's more pain coming. Jonathan, we're going to keep talking each and every week. Where can people find you?
Yeah, come find me on LinkedIn. And also would like to just give everybody a heads up that, so today is the 12th. My Apartment Investors Club is open for 1 week. So ending on the 17th, there is a brief window where you can join. So go to school. You don't have your school thing up right now, but the school.com/AIC. This is open for 1 week. So go and check it out.
There you go, folks. AIC, Inside School. Search for it. Thanks, buddy.
Okay, thanks.